back then when I was in private banking, when I talked to some of the private banking clients, they will ask about who is the sponsor or who is the owner of this company because they want to know. And it's very interesting, it's very unique, at least in Singapore, also because we want to always seek that herd mentality. We want to follow where it's safe. If it's something which is outside uncharted territory, maybe we might not want to actually look into it.
Welcome back to Chills with TFC. I'm your host Reggie, aka your Chief Financial Coconut, and today is our favorite topic. Today is our favorite topic.
It's a trending topic now,
which is REITs. So today we want to spend some time to talk about this REIT thing, what's going on, some update, but also bring everybody back down to the basics. Now, how do you look at some of these stuff, right? And actually this whole thing was because I saw Willie's post, right? He wrote an 80 plus page thing, it's a guide, right? Yeah.
It is an ultimate guide for beginners.
Yeah, I went to DM him. Anybody ask you to go on their show and talk now? He was like, no leh. I was like, huh? You spend so much effort, right? 83 pages, nobody asked you to go and talk. Come on the show and talk, right? So that's why we are here lah. But for our audience that somehow don't know you want to introduce yourself?
My name is Willie. In 2018, I quit a rat race to start a financial blog called dividendtitan.com. Since then, it's been great. So I left corporate because I was burnt out and I wanted to pursue something more meaningful and at the same time also invest for myself. That's how Dividend Titan came about. And since then, I've been writing on my blog. We have hit about 30,000 readers a month.
Damn, that's good.
Not too bad. And
he wants to bring you to write his blog already.
Yeah. That's good. And join with my favorite co-host.
Yes.
And the most interesting one, right?
The most interesting one. Your plan is still a CEO, so I came down.
So yes, for all of you that don't know him, Anthony always here with investment-focused topics. We always get him. And some of the more feisty social topics.
I think mainly investment-focused topics, which over the past few episodes have just happened to be CEOs. So, that became our running job. But yes, anything investment-related. And again, because I have a lot of money in REIT, I want to ask him my questions, right?
Yes.
So that's the reason why.
Exactly. Let's get down to it, right? Maybe just a quick overarch on what is this report thing that you're trying to do or this guide thing, like what does it encompass? What are some mantras? Because I think our audience are not as basic already. We want to get into the nitty-gritty of it, but I give you some time to talk about some core ideas that some people maybe forget already, so something like that. Yeah.
Sure. Maybe I'll just kick off the whole thing by just sharing what this guy is about and why do you even want to write like 83 over pages, right? Okay, so this whole guide is all about trying to get beginners started, their feet wet into the whole world of Singapore REITs. When I started dividendtitan.com on my financial blog, the thing is I started getting like my friends and readers asking me, hey Willie, what's good to buy out there? What REITs are good to buy?
That's always the question.
That's always the question. And
they don't want to learn, they just want a tip.
Anyway, I don't have a blog, I also get that question.
Yeah, I also get the question. Right.
Especially during Chinese New Year as well. So that sort of sparked the idea, okay, the people who are asking me are not exactly people in the market. They don't really invest full time, right? Sometimes they want to just pick up something and then just hold it for the long term. So it's very difficult for me to talk about some of my most interesting ideas. So what I did was, okay, why not compile a list of beginner stocks in the Singapore REIT world, telling them that, okay, these are some of the stocks you can get started. These are basically high quality assets. They are good landlords, well reputable. They have quality sponsors, and they've been around for quite a while in the Singapore market. So when you talk about some of these REITs, they are familiar to my friends, the readers who are asking, like, for instance, hey, do you know that the shopping mall at Raffles Place is belong to this particular REIT? So they get familiarized, they're more attracted to want to find out more. So it really just gets your feet wet into this whole world of Singapore REITs. And this is how the whole idea of the guide came about. At the same time, also to get people to understand that investing in stocks or investing in REITs, you don't have to buy like the riskiest things out there. You can actually find things which are familiar to you, things where you can touch, see, feel, you can go on the ground and see what's going on with all these properties and find out, hey, this is something which actually investing, you can actually do your own homework just by observing some of these assets. And this is how it really came about writing this guide.
Fair. I got two questions on this, right? So I think our listeners are not that basic, so they have some sort of a sense, what to look out for, some general sense of how things work, but even with this community, right, there are some questions that I think we should kind of step at it, just to be clear once and for all, right? Like the whole sponsor thing, right? Like why is sponsor dynamics so important, here? Because it's not front and center in other markets, right? But over here, right, every CEO tell me about my sponsor, like it's and then that every review article got sponsor involved. So why is that such an important mechanics in the Singapore REIT market?
So I'll just speak from the point of view as a retail investor myself, and also as an analyst when I was in banking. And what I've noticed is that for investors like ourselves, we don't typically follow how the institutions invest. We invest based on familiarity. So that's actually one very crucial point. For instance, when investors, they want to invest in a REIT, sometimes the first thing they want to rely on is who is the ultimate landlord, right? Who is the one who is running the entire property business? Is it familiar to it? And this is something which is very peculiar back then when I was in private banking, when I talked to some of the private banking clients, they will ask about who is the sponsor or who is the owner of this company because they want to know. And it's very interesting, it's very unique, at least in Singapore, also because we want to always seek that herd mentality. We want to follow where it's safe. If it's something which is outside uncharted territory, maybe we might not want to actually look into it. But if it's something familiar, like say, hey, this is a big conglomerate who is running the property and the government is inside, they have backing, they have assets from there, that leaves actually some form of safetiness. It's like I'm comfort that there's someone bigger out there, the big brother, who is also in there.
It's a bit of a reputational thing, right? Like these are big companies, maybe with one of our sovereign wealth funds being a very big shareholder in them.
Which may or may not always be the
case,
clear on that,
right?
Yes,
but
yes.
if they play pang, they won't play pang too badly. Right? So they won't come and mess over with everybody.
Yeah,
right?
but
because
the assumption killed a lot of people also, right?
Yeah.
And the water one,
Exactly.
But that one, the structure is different.
Exactly.
That's why we need to be careful, right? When we talk about REIT dynamics here and reputation here, it's really about the manager and who is backing the manager, because how they run the assets will reflect on them. Whereas I think the other one we were talking about,
perpetual bonds are different.
They have, the instrument itself is different, right? So there's a misalignment of interest.
Yes.
So there's opposing interests already in that sense.
Yeah. It's very high risk already. Anyway, who will issue those things? Right? It's very chala.
Our banks issue a lot.
Okay. That's a different.
It's a proper instrument.
Just needs to be
structured.
Managed properly. Yes.
So when you talk about sponsors, that's why sometimes it's easier. Let's say if you're a company or even for a REIT, to talk about this is the sponsor, who are they? It sort of gives comfort to the investors, to the unit holders, and even potential unit holders who want to invest in these REITs or these landlords. It gives them that level of comfort that say there's someone bigger out there who is more reputable. Now, the reason why this is also the case is also because people see sponsors or big landlords having high quality properties, which might not always be the case, but the perception is that if I'm a big well-financed sponsor, I must have good properties, good assets. That also means that as an investor, I usually would tend to think long-term, because I would think that this REIT probably would be able to get or acquire good properties from their sponsors in the long term. And that gives longevity, not only to the REIT itself, but of course to the overall rental income from the whole REIT.
So it just sounds like you need a big mountain behind you. Like the sponsor.
When there's a big mountain behind you, they put in the name of the REIT.
Yeah.
You won't be in any doubt as to who the sponsor
who owns this REIT,
right in the name.
Yeah, okay. So is there an evaluation for the so-called quality of sponsor? Is it just size?
Very good question here. Okay, I'll give the first problem about sponsors, because sponsors tend to be more quiet and they tend to be at the backdrop.
Doesn't mean they're not doing work.
REITs.
They have a lot of other things that they're doing.
Very quiet people. So sometimes as investors, it's very difficult to actually pry open what's going on inside. Having said that, having a good sponsor, of course, it's always a critical assessment. Number one, it allows you to know that I've mentioned that you can have longevity in the REIT, right? If the REIT is owned by a sponsor who has a reputable track record, like what Anthony mentioned, you will know that the assets it holds, somehow you know that when it starts to sell the assets down to the REIT, you know that these are all high quality assets, and you don't have to worry about the REIT trying to go all over the world trying to source for assets, because the property market is a highly commoditized business. Number one, there's intense competition. If you don't have your ears on the ground, right, you will lose to big players, global players like your KKR, your Blackstone, who already have information. They have a competitive advantage to finding the best properties out there. So if you are a single Singapore REIT or local REIT where you don't have a backing, trying to expand or grow your portfolio of properties, right, with high quality assets can be a challenge. So this is the reason why we want to look at sponsors. But having said that, right, there are of course downsides to it because not necessarily the sponsors which sort of have a stake or own these Singapore REITs, not necessarily they always sell you the good assets at a good price. Sometimes it can be expensive and sometimes it can be for their own agendas. As an analyst, as an investor, there are sponsors, for instance, Indonesian developer where they own a portfolio of different REITs. They did get into trouble before. They did try to sell assets down to the REIT. But the problem comes is when the sponsor faces leverage issues. That means they overborrow and they have to sort of reorganize or pay down their debt. This is what happens is that they will start to dip into the REITs to reorganize the REITs, and that will actually impact or affect the unit holders or the shareholders. So this is actually one of the red flags or some of the problems when you're facing with sponsors. On one hand, the good thing is that you know that you have sort of that backing, like a mountain behind you. But on the other hand, if you're not able to understand or assess whether this sponsor is well reputable or whether they are of high quality or they have alignment with the shareholders, then that could be a big problem, especially for retail investors.
Horrible, right? Fire sale at a premium to your own other vehicle.
There's always a bit of a concern, right? Because as much as in Singapore, it's all meant to be on arm's length, you have a third-party valuer come in, it's always kind of a shifting of an asset. And there have been a few transactions in Singapore, right? From the parent, which is also a listed company, to the REIT, right? So the parent sells to the REIT its own property that it continues renting. And sure, we have all these third-party independent people to come in and say that it's all independent, it's all arm's length, it's all at market price. It might even be DPU accretive. But at the end of the day, in terms of intent, it's not the parent cutting off its own nose, right? To give it to the REIT. Like, it always feels a bit self-interested, even if there is nothing that actually substantiates that.
Yeah. So I think the main idea is don't sensationalize these things, right? Because there will always be marketing messages, that PR, IR, their goal is to make it sound good, right? But understanding the mechanics at the back, like the DPU accretive, some of these things, right? Where does it add to the bottom line? How does it work? The mechanics, it can get a little bit nitty-gritty, but I think as you develop as an investor, all these things become important to explore. Okay. So maybe one more thing to expand a little bit about, you did say some of these like so-called riskier REITs, right? So the assumption when people think of REITs, right, is very safe, this is a piece of property, right? Like, so it is what it is, right? But the recent one especially, because it's fresh in memory, a lot of people also kena, right? Based on the interest rate adjustments, you see all sorts of weird things happen in the REIT market. What is your take on some of these things? How should we evaluate so-called risk of the REIT? Because it's always so as safe, but is it true? Yeah.
So there are a couple of things which I tend to look at when it comes to REITs in general. I think number one is gearing ratio is definitely something which everyone talks about. As an investor, you don't want to ignore this because this tells you how aggressive the REIT is, number one. And when times go bad, this gearing ratio can actually balloon or it can actually inflate. As you have seen, a lot of the smaller REITs in Singapore which owns foreign assets, when interest rates go up, the value of these properties drop. And that actually increase the gearing ratio significantly. But more important, right, when we look at the gearing ratio is also the amount of interest which they're paying. So that actually affects the amount of distribution or DPU which they actually collect from these properties and of course paying to the unit holders. So gearing ratio is one. Another one which I always focus a lot is the occupancy rate and the tenancy, whether the foot traffic of the REIT itself. So occupancy rate, looking at whether these buildings or these properties are able to actually command what you call a competitive advantage in that location. That means able to always fill the tenants. What do I mean by this? If you see there are REITs where properties, the occupancy rate might not be very healthy. They might be struggling, even though they might be in very prime location. That could be a problem. And this is something which I want to also say. A lot of times when you talk about REITs, right, the first thing as an investor, what you do is you go to Google Map, you see, if the property is near a transport node like an MRT or a bus interchange, that must be good property because there's foot traffic. But that can be further from the truth because not everywhere is like Singapore and not every transport location functions the same way. I always highly encourage investors to, if you can, go on the ground to sort of get a feel of how the property, how the building is. Because sometimes, a shift in a physical location, right, just even though it's just adjacent or just beside, it can mean a lot to how consumer foot traffic or the behavior is. So I think that's actually very critical.
And these things, I don't think there's really a consensus around the formula of it, right? It's like, why this road, it's the same road, left, right, right side more people, left side nobody, right? It's like, why? It's then the feng shui masters will come in. But no, there's no consensus as to why it's like that, right? I think I just want to highlight because a lot of the REITs in Singapore are getting more and more matured. In other words, they run out of things to buy here. They are all buying abroad, more and more of them, right? So I think some of the Singaporean mentality of how properties work, right, need to go, right? You need to evaluate it locally in terms of how things are done in different places, right?
Yeah, but I guess this is also one of those things where it comes down to size, right? So for example, if you have a REIT that has 5 properties, you need to make sure that all 5 are good. But when that REIT has 500 properties, you're not going to check all 500, right? You're going to kind of take that the managers know what they're doing. They have decently good properties aggregated as a whole. They have like 97-98% occupancy. You won't go down and check, right? Because it's just so big. 1 or 2 properties will not make too much of a difference anymore. And that's one of the advantages of size as well, right? I mean, we like to talk about diversification in terms of the number of condos we own and things like that. But a differentiating factor between like a REIT and let's say buying your own industrial property is that the REIT owns so many more of them. And then they are subject less to like tenancy risk. They can manage a whole portfolio. And so if they buy in multiple countries, if one country goes down a bit, the other country is still okay. They're still okay. So it's always things like that help. And that's going back to your report, that's why a lot of them I think are extremely, extremely big REITs because there's that bit of safety in that sense.
That's a good segue into evaluating the market today. I think we want to have a deeper evaluation of the situation, what's going on, what do we think will move forward and all that. So do you have some sense on what's going on now in the markets?
Yeah, I mean, if you look at how the Singapore REIT has performed, over the last 3 months, it was up about 15%. And then over the last 5 years, it has sort of broke close to its all-time high.
We reached a new all-time high. Did we? I think we did.
So I think this really was the result. I mean, just to give a backdrop, it was really the result of the Federal Reserve. They are looking to actually cut interest rates, which they did early in September. And they have also said that potentially they want to gradually reduce interest rates, which is a good thing for Singapore REITs, right? Because when interest rates drop, typically it's good for REITs, for properties. The valuation goes up because how properties are measured or REITs are measured is not exactly based on the profits which they're making, but from the future dividends which they are able to actually pay out to their unit holders. And this is affected by interest rates because the value of all this future dividends to collect goes up. The value of this REIT shares go up as well. That's what we are seeing in the market right now. And that's what's really driving the Singapore REIT market. And another thing, of course, if you look at Singapore REITs, after the COVID-19 pandemic, the Singapore economy, for many of the property across the different sectors, you'll notice that there is a gradual climb in the rental rates for many of these properties. So that's also what's driving the performance of Singapore REITs. On one hand, you have the macroeconomic environment, which is very supportive of these Singapore REITs. Another thing is that from a bottom-up perspective, these landlords, they are, like what you said, they are squeezing rents. And it's very difficult to negotiate because they know that the property which they sit on will have a healthy streamline of tenants coming in. So if I'm not willing to agree to the increase in rent, then they'll just kick me out. They'll just bring in another tenant.
Sometimes all these other places, I don't know where is all these tenants, constantly coming in such that the landlord feels so confident that they can raise the rent consistently and not afraid of it, right? So, but yeah, it is what it is.
I think for some landlords, and again, conspiracy theory, they're okay with having some vacancy so long as they can have a headline higher rental because that affects their valuation. Because when the third party valuer comes, they go, oh, actually, what's your rent? I mean, they look at your rental rate, they look at your tenancy. So it is not necessarily better for them just to fully lease it at a lower rate from a property valuation perspective.
Fair. Because they're evaluating potential, right?
Yes.
Okay.
I mean, speaking of stickiness and also follow up to what Regis mentioned about where are all these tenants coming from, I think I sort of believe in this 80-20 principle, right? 20% of the properties in Singapore probably attracts 80% of tenants. And if you notice, it all boils down to the competitive advantage. Like any businesses, we all talk about durable competitive advantage. In REITs, in properties, also the same thing. Your competitive advantage is, of course, your location, the quality of the asset, and that inevitably, I think, attracts the tenants. And I think tenants, they are also smart as well, right? They also want to flock to the best property or the best offices or retail space which they could find. And I guess that's probably the reason why, if you are in, very popular areas with good location and very feasible for the tenant, inevitably you will attract a good crowd, even though, you're talking about maybe a headwind in a particular sector.
Hey, welcome to the Financial Coconut Podcast Network. I'm your host, Reggie, aka your Chief Financial Coconut. And if you're loving what we're creating here, like, share, subscribe, share with your loved ones, comment in the comment section below. And yeah, we'll see you for great content on Chills with TFC.
Okay. I want to kind of dig a little bit on the whole interest rates, right? Because we all know the REIT is a leverage tool. Pretty much, right? You open an entity and then you increase your leverage, you put down some of these things that you own on the whole balance sheet, you pass down to the REIT, right? So that's pretty much the baseline structure of all REITs. And that's a big reason why this whole interest rates, capital management or credit management becomes a very big part of REIT. So expand a little bit on this, what is the reality going forward, right? What's the possibility, from your read of the situation?
So if you're asking me about the prediction of where interest rates are going, I mean, for me, it's very difficult to find out exactly where interest rate will land.
Of course. Yeah.
But when it comes to gearing and leverage, right, actually, I have a very contrarian viewpoint. So it's a bit different from what many people think. And, earlier on, I talk about looking at gearing ratio. For me, what I like is actually looking at REITs where they know how to meaningfully use gearing. What I mean by meaningfully, meaning that they are able to actually really take advantage of gearing. Because if you see, right, REITs, at the end of the day, they are essentially a financing vehicle. They borrow money from investors like ourselves, they borrow money from the bank, and they just invest in assets which are higher yielding. And that's it. So if your cost of borrowing is cheap, is low, and if you have a good rental rate, you're going to make money with a REIT. And you can take this model, you can multiply it across different properties and assets. So if you notice, right, a lot of the Singapore REITs, actually, many of them, they are very conservative in terms of their gearing. When MAS came out with the ruling that, okay, they are going to increase the headroom, actually, I was pleasantly surprised about that because it took them quite a while to reach that state. If you notice in the US, where they have a long history of REITs already, they don't have a gearing limit. A lot of them, they can actually go up to 60% gearing. And I asked myself why? Because if they can do it, then Singapore probably can do it. Of course, then it comes to the question on the assets. So for me, in response to how you asked me the question, how I'll actually look at it, again, it boils down to a bottom-up analysis of the assets. You cannot escape, no matter talking about interest rates, about the macroeconomic environment. The number one thing which at least all retail investors we should do is to assess the property from a bottom-up angle. That means, again, looking at the foot traffic, the quality of the assets, who are the tenants, and at least going down to see and observe how, for instance, the REIT managers are doing, how they are improving the overall layout. Are they doing good renovation? Are they maximizing the square footage? Are these REIT managers very sharp, astute managers in terms of financing? So one thing which I've learned as bond analyst years back in private banking is that Singapore REITs, what you really need, right, other than a good person who can find good properties, is someone who can identify or price their interest costs, manage their gearing, manage their interest, being able to, what you call in technical jargons, being able to ladder out their debt maturity. And sometimes as a REIT manager, you might be doing things which are very unpopular, unfavorable to your unit holders, like issuing massive rights issue or taking on huge amount of leverage when maybe you don't really see the need to. For instance, because you foresee, a danger ahead and you want to take advantage of the cheap borrowing. So these are some of the little nuances as investors you might want to actually keep a lookout for. It's not easy, but just by trying to look at some of these indicators sort of will give you a little more understanding about who these REIT managers are. And coming back to ESR's manager, I actually applaud Adrian. I have actually interviewed him.
That was in my head. Adrian cannot whack for so many years. Yeah, because he exactly the example is Adrian, right? Like he issues so many distribution units, he does so many other weird things, and people keep whacking him.
So it is a very contrarian play. Sometimes not a lot of investors are able to see past that because firstly, it is very common and it's normal that sometimes you might not trust what the manager is doing, especially when our money is put in the pockets of some of these investment trusts. So this definitely there's always that doubt and skepticism. But as investors, we have to understand the essence of what a REIT is. It is, at the end of the day, a financing vehicle. You have to accept the fact that it's a financing vehicle, which means that you need someone who is capable of understanding how financing works, how to get good financing, how to talk to the banks, work with the banks to get the best rate for buying out a property, how to actually choose all these properties at a good price. All right. This is something which I will actually come to that. So it's not so much about trying to look at what the Fed is saying or what's going on with the macroeconomic environment. It's a lot about trying to ride through the cycles by having a very keen understanding of all these properties. And you look at it by understanding where people don't usually look at things like your debt maturity profile. So if you go deeper, more than just gearing ratio, you look at the debt maturity profile. How are they splitting up when some of this debt will be refinanced? How have they protect the ups and downs of interest rates? Meaning, how do they hedge it? And how expensive are these hedging costs? And when do they expire? So some of these simple questions sort of gives you an understanding on the financing manager or the CFO of these REITs. And, it gives you a better insight to try to understand some of the assessment.
Okay, without sounding like we are shilling for Adrian, you wanted to say something just now about him?
No, I think Adrian is an astute manager. I think it's not easy, especially if you are trying to manage logistics and industrial properties. Like what you have mentioned, Reggie, I mean, this is one sector where you really need to have that kind of energy and passion to really manage industrial or logistics property, because the tenant profile which you're dealing with is different from the tenants in the CBD area. Right, you are facing with taukeis who might not have gone through a university degree, and they can play punk with you. It's not like MNCs where you have a proper rule to follow, so it's easy to negotiate for rent. But look, you're looking at small, medium businesses, and it's definitely not easy dealing with small and medium business tenants, especially, when you're talking about cash flow, the credit health of these companies. They can forfeit your rent, they can choose not to pay you anytime.
And a few points to pick on that, right? On what you have said. So I think starting from the difference between the Singapore and US market, REITs markets, because of that differentiating factor in terms of the Singapore limit on leverage, and also because we have to pay 90% out in distributions, I think the profile of REIT holders in Singapore are very different from your profile of REIT holders in
You just
US.
need to go for an SGX event, right?
The Singapore REIT is an income instrument, right? It's meant to be maybe a bit like Singtel. They provide you with stable payouts year on year through various property ownerships and rentals. So that's the nature of it. And that's why there isn't that much growth in a sense, right? Because if you want to grow, you don't put that entire structure in a REIT. You maybe put it in a business trust, you put it in a developer, you put it in some other sort of entity. Because once you have to pay out everything, you cannot retain earnings. Once you cannot borrow money, how are you going to buy a new property? You do rights issue, dilute, you take on bank debt, which is limited. So I think that's one. Two, we talked a bit about the macro tailwind of lowering interest rates. I think my slightly contrarian take is I don't really see how it matters, because I get the point, it reduces SOFR, reduces interest costs, but over the past few years, everybody has been at pains telling you, I have hedged against higher interest rates. Once you have hedged against higher interest rates and you are expiring 2025, 2026, lowering interest rates works against you. You have fixed your interest costs. That's the hedge. So you might not necessarily get as much of pass-through in terms of lowering costs. It really depends on, I think, when the hedges were put on, and to your point, when they'll come off, because that is when you actually realize the direct cash flow benefit of a lower interest rate.
A lot of these operational elements where...
So find a good manager.
Yeah. It will reverse, right? Like the longer the environment stays fixed in a certain environment, every entrepreneur knows what to do about it. Everybody will be doing everything to get it sorted. So now that, the environment, it looks like it's going to change, I think a lot of REIT managers, they're not talking much. In fact, it's the media that's talking a lot.
The REIT managers will not talk about hedging interest rates anymore.
Yeah. No more.
That's not good.
Yeah,
they will still disclose it.
Yeah.
You'll still have to dig through their financial reports to read it. But a year ago, they have been boasting, we are 80% hedged over the next 3 years.
I'm not sure if it's boasting or just trying to give you comfort.
A year ago, they would be giving you comfort. Now they will not mention it. But you still have to look out for it.
If I read my guide, right, so I've been talking about maturity profile. So that's one of the key factors which I tend to regularly talk about, other than gearing, talk about the maturity profile. Of course, whether they have hedged their interest costs, that's also another key thing. And of course, trying to understand what has the REIT done, in the past, in how they sort of pivot. Say, for instance, one of the blue chip, which I've written in my guide, Capitaland Ascend Trust. They're actually very interesting because they have a portfolio of very diversified properties, and mostly they're all freehold leases. And during the pandemic, what happened was that because no one could travel, the whole hospitality and hotel industry was shut. What they did was they pivoted into student accommodation. So they were very quick to adapt to the entire environment, where most REIT managers weren't able to actually adapt fast enough. That's why they started to incur huge amount of cost. Occupancy rate starts to drop. Capitaland Asset Trust, they decided to sort of pivot some of their strategy. Even for Mapletree Industrial Trust, Ascendas REIT as well, some of these traditional industrial properties, which by the way is also inside my guide, they also have pivoted into data centers, for instance, and that also helped them to not only expand their portfolio, but at the same time, a bigger portfolio allows them to get better financing cost.
Then the flip side of that is the lack of stability. So to the extent that you have a REIT that when you buy it says I am focused on, let's say, US office property, then suddenly when the market shifts, you also shift. It's good and bad. Like it's a double-edged sword, because if they shift well, obviously with hindsight, everybody says it's good. If they shift poorly, then too bad.
But if they don't shift, it's also a problem.
No, but
right?
then that's the thing, right? As a unit holder, I can choose to sell all of it. Like I would rather know that you have a fixed mandate, because if I think that US office is going down, my expectation is not for you to change the mandate to something that you think works. It's for me to sell you and your price drops and then I go buy something else. So I get that, having good management is good, but from a unit holder's perspective, I also want some certainty that you will will do what you say.
You promised me your strategy, right?
Yes.
Then when crunch time, you change the strategy, right?
The concern I have is when you are changing your strategy to catch on a hot trend that you might not necessarily have expertise in.
I agree.
Like how much is a data center similar to a logistics property?
Totally different.
In terms of management, in terms of build out, in terms of fit out, are you the best placed person to actually own and develop and rent out this property? Because if you're not, then I want data center exposure, again, I go buy a data center REIT, or I go buy Singtel, or I go buy somebody with data center exposure, right?
Yeah.
I don't need you to try to get your book value up so that I maintain a relationship with you. Like there's a bit of a disconnect there.
I understand what you're saying, right? And the thing is, within the REIT space, somehow there's this flexibility. Somehow it exists relative to the more structure of the market type of products, right? It's very different. My point of view is, although they change their mandate, I still can sell. Especially after they change their mandate. Tell me, this might change mandate, so sorry. I can go. So I'm not so hard about whether they expand or adjust their mandate, but it's really more like whether the strategy makes sense, I think we can price COVID as a bit more of a black swan. Not every day these things happen, but these days more and more black swans are happening.
Yeah,
right?
If something really bad happens, fine, we accept it. Good for a manager to have flexibility, but this is not a power that should be used and exercised lightly.
Of course.
Right? To me, it's really, okay, what we thought of as the market has fundamentally shifted. So we are shifting.
Yeah, fair. When we're not talking about like super beginners, right, I think the more mature retail investors, they are all on board on this, right? So sometimes the REIT manager tell me I'm very stressed when I do the AGM, right? So all sorts of questions will come in.
Well, they have to feel stressed when they're paying the big bucks.
Yeah. because the Insti will have private channels, right?
Yes.
They don't need to be there, right? A lot of the AGMs, you see a lot of retails, people that will be there, and then the questions can be quite harsh. So even when they try to make adjustments to the mandate, right, I can tell they're quite nervous, which not necessarily is a bad thing. Right, that means
they feel responsible.
Yeah,
that's
they feel responsible, and a lot of retail investors are getting smarter and wiser about it rather than just blind faith around it. So that is good. Any other things you want to expand on?
So speaking of mandates, right, I do agree on this. Sometimes you don't want to have a very hard and fixed mandate, and sometimes you want to change your strategy. But for me, because as a minority investor, as a retail investor, I personally got burned by REITs before. It boils down to the mandate issue. And what I would sort of give a little tip or advice here is that I think it's all right for REITs to actually evolve their strategy. You have your industrial properties going to data centers, expanding their portfolio. That's fine. You have hospitality REITs going into student accommodation. So there's an extension of the strategy. But what I would be more careful about is if the mandate takes a 180-degree turn of changing, going from
shopping mall
one
to
sector
data center
to a data center
how are you doing?
or logistics. And sure, there might be nothing wrong with that, but do you have a strategy to it? Like, do you have the team in place? Do you know the cycles? Because each sector cycles behave very differently. And, do you have that team or that talent pool in place to manage those properties? And on top of that, if you're going to change this strategy, what makes you so sure as a REIT manager you're able to get good properties in the new sector in the future? Because you will be fighting against some of the existing top players who are already in that sector and already have the information advantage. They already know the game and everything. And if you are changing strategy, do you have that kind of competitive advantage? I think that's something which, as investors, we can ask ourselves and we can think about it, when we are assessing a REIT.
Fair. So in some ways, running a hotel and running a student accommodation, okay lah. Yeah. Like running a logistics business, running warehouses and an aircon warehouse called a data center with more sophisticated wiring. It's pretty much an aircon warehouse with more sophisticated wiring and cooling systems.
I think they'll be very angry at you for saying that.
Because I was in the cloud computing business for a while, so I have a decent sense of how this thing works, the rental systems, how the mechanics work. But pretty much it's an aircon box.
Yes. Then going from hospitals to going to like, retirement homes. Also
okay,
kind of the same.
Right? Just I don't want to see a shopping mall in the logistics business, right? Don't tell me you're gonna do a data center in your basement. I don't care, right? Like,
or you don't want to see office go to shopping mall. Even if they are like at the same location.
Yeah, because the mechanics is very different, right? Even though it looks like all these grade A buildings, right, downstairs can become a retail mall, but once you enter that game, it's a different game. The audience, the people that rent from you, what they look for is different.
Yeah, I mean, I've personally lost money investing in a particular healthcare REIT, which invests in hospital-related assets. And then when something happened to the sponsor, what happened was the share price started falling. I think it was down about 20-30%. And then the REIT decided to pivot into nursing homes in another country. So I lost quite a fair bit of money from there, but it was a very painful lesson learned, thinking about how the REIT mandate, how it should evolve and not sticking entirely to what the REIT manager says. I think that's important.
And I want to add a little bit on that, right? Because there are some REITs based on a certain category, their price to book value, right, is higher than 1. So in these type of sectors like healthcare, logistics, the building is less important than how it's operated. Because the building you sell is just like a 5-level story building. You can come in, you can run a school, you can run a daycare center, you can run a nursing home, you can run different things in this same building. And these type of properties, the operational elements become extra important, right? So running a hospital versus running a nursing home, the profit margins are different. So I think some of these things are important for our audience to get a better sense of. Right, okay. So the most important question, right? Has the ship sailed?
Can still buy or not?
Can still. People stay
if
all
I still
the
want
way.
to buy, what to buy? Besides the 10. Besides the 10.
Yeah.
Besides the 10, I thought we were talking about the 10.
Okay. So come.
I will talk about the two different things here. So one, I'll talk about the guide, the other one, which is outside the guide. So I'm not very focused on the individual sectors. I tend to focus more on two things, right? The quality of the assets, which I've said earlier, and of course the dividend yield as well. So one of them, of course, is Capitaland Ascot Trust, which I still like. I mean, well-diversified portfolio. The thing about REITs, what I like and what I tend to pay attention to is diversification. No, it's a lot like when we were much younger, right? We used to watch Power Rangers. If a Red Ranger or Black Ranger try to fight with a monster, no way. But if you have your red, blue, pink, everything together, they're unstoppable force. So this is something like when I'm looking at REIT, it's the same thing as well. So Capitaland Ascot Trust is something which I like. It's yielding about close to 7%. And it's very different from, for blue chip, you don't really get this kind of dividend yield every day. And you can see how they are sort of reinstating their dividends over the last couple of years. So this is one which I like from the guide. Now, I have separately one which I also like, which is a bit different. So let's say if you are more than just beginner and you want to get more committed and serious, I have what I call a director's cut list. So this is something which I
didn't make the 10, but it's still quite good. Right?
It made the 10.
It made the 10.
It made the 10. So a director's cut is something where you want to put in, but you don't put it in.
Okay.
And you don't put it in for many reasons because the guide is really on a beginner's guide, right? So a director's cut is something which I actually spend a bit more time and effort. So one of them which I like is actually a slightly smaller REIT. It's called APAC REIT. It's an industrial property, industrial/logistics. I think they are a very astute manager. Just to give a history, APAC was actually acquired as a distressed asset many years ago during the global financial crisis by AIMS Financial Group. So they have a very outstanding manager back then. They bought assets at a very cheap price, and that's why you see APAC, their properties, the yield on their initial purchase cost on these assets is actually very high today. One thing which I like about this REIT is that they have been very sleepy. Sleepy in a sense where they don't really do much things. They own the same property 15, 20 years ago. They have not much changes. If you open up the investor relations slides, it's going to be very boring because you're just going to see the same old property over and over again. And it aligns a lot with my approach as an investor, being conservative. Conservative meaning that you don't sort of chase the trend, right? You sort of, what's important for a REIT is you want to ride out the capital cycles or the property cycles. Because the worst thing which happens for REITs, right, it's not so much about going in the uptrend. everyone's enjoying the good times. But what happens is that when the cycle starts to crash, high interest rates, property market, everyone doesn't want to rent anymore, rental price drop. That's where it really tests the power or the managers of these REITs. And you want to actually look at these REITs which are able to ride the cycle. And in order to ride these cycles, first of all, you must be able to have assets which have been acquired, or you might have bought all these assets at a very good price. This gives you a sufficient margin of safety, or what you call room for error, right? Let's say if the market crash, you know that the value of the property which you own is still intact. You have not overpaid for many of these assets in the REIT. So AIMS APAC was something which I like. After the financial crisis, when they restructured the whole business, they were able to ride cycles all the way till now. So I thought I was quite impressed with the management, and they never really struck to me as a REIT where they have been expanding aggressively. Right now, you see a lot of industrial property or industrial landlords. What they're doing is that they're moving into data centers. You don't really get to see AIMS doing this, although they try, but they don't do it in a very aggressive manner. They are very picky about what they're choosing in terms of their assets, which is very much in line with how I also pick stocks or businesses. I want to be as picky as possible when I try to look for high quality assets, and of course at a sensible price.
Fair. And I think that particular industry has gone through quite some consolidation over the past few years. So it's interesting because when consolidate, then left a few people, right? Left a few people, the negotiating power becomes interesting. So it changes the dynamics. There's a lot of those things that come to play.
Exactly. And it boils down to the laws of distribution, right? So again, the 80-20 rule, you get to see, like what you mentioned, some of these powerful landlords, industrial landlords, soon able to actually command, the 80% market share from this, 20% group of landlords here.
Yeah. Fair. Interesting. So what is your take? Has the ship sailed?
It's okay. No, I mean, at the end of the day, it all back down to what you want REITs for. What's your intent? How's your portfolio constructed? What do you think the purpose of REITs are for? To me, it's always been REITs are, not safer, less volatile. So I can take it down. If every year the distributions, they give me enough to pay my Netflix, hopefully pay income tax, pay my insurance, then okay lah. It's a step towards retirement, right? Because if you want to retire early, you need cash flow coming. But more consistent way of getting cash flow than from REITs. So that to me is safe. I want them to be less volatile, go up, go down. I didn't do anything, right? Go down, I bought a bit more, go up, not selling. Unlike a US stock, right? Go down, buy more, go up, sell. So I think, because of that, will I continue buying as my portfolio increases? Sure. Right? Because I want to, and then as I get closer and closer to retirement, sure, I want more and more less volatile assets. But for now, is there really that much of a tailwind to REITs due to macro? I don't think so. Because at the end of the day, whether lowering interest rates is good for the stock market or bad for the stock market, it really depends on whether we are in a recession. We don't know whether we're in a recession. It might happen, it might not. So if you say that a year later, stock market will definitely, you are implicitly saying that there will be no recession. And I don't feel qualified enough to make that judgment. And I don't think any of us here feel like they want to make that judgment as well.
Yeah.
So if you have a plan, then just continue executing against it.
I think it's pretty interesting because if you look from a top-down point of view, right, just following up from Anthony, there are about 40 plus REITs today. If you just look through, it's not that difficult to just look through all the REITs. I would say that really less than half of the entire REIT market in Singapore is really worth looking at.
No, sorry.
This is what I would say.
This was the problem I was going to raise with you. Like, I look at your list, right? It's like, hey, I might as well go filter by top 10 market cap. I think there's 9 of them there already, except for one.
I mean, you have to come from the angle that a lot of investors, they're starting out. So they're just trying to get their feet wet. They might not know a lot of these REITs. Sometimes you tell them, oh, I'm looking at, do you know that Ocean Financial Centre or MBFC is actually owned by Capitaland REIT? And some of them, they might not even know. And this is how, you want to sort of let them know that, hey, there are actually some of these REITs with high quality assets. And you can actually start looking at it. I think this is one crucial point there.
So with that, thank you for your time. If you want to follow Willy's list, we'll put the link below, right? And you can connect with him on LinkedIn. Is it a good place?
Yeah,
and then
great.
We'll see you in the next episode. Okay, thank you guys. Bye.
Bye.